Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us for a look at markets now is John Lynch, CIO at Comerica Wealth Management. John, it's kind of a conflicted bull market that we have here at the moment. I'm curious whether you see the CPI report this week or the Fed decision and its dot plots, likely to change much this week.
Hey, Brian, good morning. Yes, I think first off on the CPI report, I noticed earlier the Bloomberg consensus is only calling for a 0.1% increase month over month. And I think that's a bit of a stretch. I think that's a little optimistic. We've seen really good job growth. We saw a rebound in services. Auto sales are approaching 16 million at a seasonally adjusted annual rate. So I think that the street might be in for a disappointment on the month over month data on headline CPI. To the degree core CPI comes in about 0.3, hopefully that'll be the saving grace. But I do think investors should be mindful of that month over month print. And to your point on the FOMC, I guess at the end of the March meeting, the dot plot was for 3 cuts this year. As you know, Fed fund futures are looking at exactly half that amount. And it'll be very interesting to see whether or not they come out with 1 or 2.
So do you think there's a real risk then that the bond market maybe sees a little bit of weakness and we have a pop in yield right now? The last couple of days have seen a dramatic decline in yield, and I saw the way in which bank stocks were squeezed particularly today. Do you think there's a risk that yields pop from here?
I do. I think, we've been looking even globally, we've been in a downward trend, but we saw surprisingly strong demand for the 30-year, for the 10-year auction today. There were 39 billion, I think, and we met with really strong demand. So we're right in that, lower bound of the 430 to 470 range that we've been trading in. We're about, I guess we closed at 440. But yeah, we could see a pop, 5 to 10 basis points should that month over month number disappoint.
Yeah, it seems like that there was quite a lot of relief today with the Treasury auction that, that there was demand, strong demand. Why do you think there was, given, the previous somewhat failed auctions and the fears that, at some point the bond vigilantes will be, back in force?
You used the perfect word. It was relief. It didn't seem like confidence to me at all. I think it was very much relief given the poor auctions that we saw on 5s and 7s over the past couple of weeks. So I just think, the bond market is really in, right in the mid 4s. We could really, frankly, break either way. If you think about all the money that's been spent post-pandemic, deficit spending, we're 1.6, 1.7 trillion budget deficit in spite of 4% GDP. I mean, that's not a full employment type read. So you could break upwards over the next 6 to 12 months on that, or heaven forbid, we have, a worse geopolitical situation, which could see us break lower. So I think, again, very instructive that you use the word relief, because I think bond investors are kind of straddling the fence on that.
John, I'd like to get your view on what you're seeing with respect to this artificial intelligence trade. Yesterday, we had Apple unveiling this new platform called Apple Intelligence. Maybe a delayed response today. The stock was weak yesterday, but I think analysts kind of weighing in on the fact that maybe this creates an upgrade cycle for the latest version of the iPhone. And today, Apple shares popped more than 7% to a record. Are you still a buyer of this AI theme?
It's interesting. Apple faced a great deal of criticism yesterday on the rollout, but I think, I don't know if you want to say cooler heads prevailed or more optimistic heads prevailed today. The AI thing, I'm still behind it. I've been asked a lot about 1999, and when I just see, if you want to use the Cisco versus Microsoft or currently Apple or NVIDIA example, multiples are very different. It's a different type of scenario. The growth companies driving this not only have earnings, but they have significant cash flows, and they're trading at significantly better multiples than we saw some of the leaders 25 years ago. So yeah, I'm still behind it. I like the fact that businesses are confident enough to spend, and we saw durable goods orders, right? So business is spending on employees and they're spending on orders, and to the degree that you're seeing, even within the tech space, semiconductors outperform software. So that's a pretty good cyclical indication at this point in the cycle. And you can even see that on equal weight basis as well.
So I want to give you a quote, and I want to, sort of introduce you to the reporter's notebook for why I'm quoting this. I get up at 3:00 in the morning for this show, and sometimes wake up at about 1, and I just get my book and read for a while and hope to go back to sleep. So I read this line in the book that I'm reading at the moment. It's back at the beginning of the chip industry, and I'm paraphrasing. Texas Instruments had sales of $500,000 in 1958. 2 years later, it was $21 million. That's sales jumping 42 times in 2 years. And I was thinking, hey, take that, NVIDIA.
Absolutely. Good quote. And it's a labor of love when we wake up at that hour, isn't it?
Well, the point really of the anecdote is that, we're so surprised at, how fast AI is growing. But, we forget that there's been a number of these trends. Semiconductors in the early stages were just doubling and quadrupling and quintupling and you name it, 42 times in 2 years. It's impressive.
Absolutely. Absolutely. Not only were they doubling, but the prices were cut in half, right? Moore's Law. So, the speed with which we've seen over the last 25 years, that's why I don't think the whole NVIDIA, Taiwan Semiconductor, Microsoft, you name the participant or the leader in this shift. I still think there's room to run. And when it's consistently justified with quarterly sales growth, year-over-year sales growth, the margins that they're seeing. I do think it's important for investors to really think about why utilities are running. And, we want to make sure that the electrical grid can support all these data centers that all these chips are going to populate.
Yeah, it's a good point that there are a lot of companies that are not buying AI, and having to expense that. They're selling into it. John, thank you for joining us. John Lynch, CIO at Comerica Wealth Management. Let's bring in JoAnne Bianco now, partner and investment strategist at BondBloxx, to take a closer look. So there was quite a lot of turbulence in France in particular with the rout in French bonds. And I guess quite a few people are angered that Emmanuel Macron called that snap election, with Bruno Le Maire warning that France could be plunged into a debt crisis if Marine Le Pen were to win the elections. I'm just curious about your thinking about whether that impacted the fairly strong bond auction we saw in the U.S.
It's very possible that it did affect our bond auction here, but it's also possible that, sometimes bond auctions go better than other times. And today was just a day where there was strong demand for whatever reason.
Hey, JoAnne, I'm hoping you brought your crystal ball with you, or it's right there next to you at the desk. Give me a sense of what we're going to see tomorrow. First with the CPI and then what we're going to hear from the Fed.
Yeah, it's going to be a big day tomorrow in terms of market events with the CPI releases and the FOMC rate decision. I think that, no matter what we see in terms of the CPI release, it's not like inflation is handled. Maybe we could continue to see some progress, but we're not at the point where we think that there will be a rate cut obviously announced tomorrow or even the July meeting. September would be potentially the first time that we could see a rate cut. But even then, now the probability is less than 50% that we would see a rate cut in September. So it may not be until December of this year where we see the first rate cut.
It's a doubleheader tomorrow that I'd buy a ticket to see for sure. In fact, we'll have to be talking a lot about it on the show. How would you like to have Jerome Powell's job, trying to explain what's really going on in the jobs market, looking at the huge difference between what we saw in the establishment survey versus the household survey?
Yeah, exactly. It's not an easy job that he has, but I would just say that in general, even though there can be some weaker numbers, some stronger numbers, overall employment and payroll numbers are holding in at strong enough levels. They're not really a real cause for concern, meaning that the Fed would have to consider cutting rates tomorrow.
So do you believe that there are still opportunities in the bond market? I mean, I'm imagining that if you think the Fed could go 25, maybe 50 basis points before the end of the year, that just on the basis of a capital gain that you may receive, there are opportunities. Am I right on that? And if so, I mean, what part of the curve are you playing here?
Yeah, no, we think there are a lot of opportunities in fixed income right now. We certainly see opportunities still in the credit markets, in investment grade corporates, particularly triple B corporates, also high yield corporates, just because we do have these continued strong fundamentals for U.S. corporations, and that is something that we have elevated yields. And if the majority of the return for fixed income is from coupon income, you're getting, you could get elevated returns in credit because of the elevated coupons. In terms of how we feel about treasuries, we're still kind of sticking to our view to focus on short to intermediate duration exposures. The short exposures, there's definitely, you still are experiencing income in the low 5% range, and they have lower volatility versus longer duration U.S. Treasuries. But we also think that it's time to do some stepping out in terms of duration in order to capture not only attractive yields, but price returns that would result from potential Fed actions.
I'm a little curious about your high yield choices, and wondering whether or not you're at the aggressive end or at maybe the more risky end, given what you see in commercial real estate.
The high yield market has held up very well in terms of the fundamentals. We're still at interest coverage ratios and leverage ratios that we saw not since before the pandemic. There's been some softening, but in general, we're not seeing a big wave of downgrades. We're only really seeing one industry that is experiencing more distress, TMT, but a number of the other industries are doing quite well. And in terms of the rating categories, it just depends on where you want to be in the risk spectrum. If you want less a risk, then you would probably focus on double Bs, and they can be a great addition.
Sounds good. Thanks very much for joining us here live on the program. JoAnne Bianco, partner and investment strategist at BondBloxx. Looking at China's consumer prices, rising a little in May, still holding above zero. It's the fourth consecutive month that we've seen that. The CPI reading up 0.3% year on year. The survey estimate was for 0.4%. And in terms of PPI, still locked in deflation with a contraction of 1.4%. It was a little better than the survey estimate of minus 1.5%, and quite a bit better than what we saw the prior month in April, where we were down 2.5%. Joining us now is Vanessa Chan, head of Asian fixed income investments at Fidelity International. So I guess not too much of a surprise, Vanessa, with these inflation numbers in China, but it kind of suggests and shows that it's a long road ahead to get back to normalcy.
Yes, indeed. I think, as you mentioned, the numbers is probably a little bit better than market expected, kind of slightly a fainted improvement, quoting some of your colleagues earlier on. What we're looking at is our longer-term view on China is a controlled stabilization in general. We're looking at a GDP of about 5%. Inflation is probably likely to kind of hover at a relatively low level. What we've seen recently is some of the policy that's been implemented, such as the kind of ultra-long bond, which aim to putting more momentum or investment into the longer term infrastructure projects. We also seen policy related to property in terms of relaxation. And all of these is really trying to regain some of the growth momentum, particularly related to the onshore market, in order to help the kind of gradual improvement that is expected from the central government on the domestic consumption side as well.
Yeah, domestic consumption, I think there's a big question mark over that. What seems clear is that the economy is still very reliant on exports, is it not?
Yes, but I think we recognize the economy traditionally have been relying on, I would say, two things. Three maybe. Property, infrastructure, and also export. There's a very strong intention from the central government of the gradual structure change for the Chinese economy to kind of bring it back to more domestic consumption and manufacturing. So what we've seen is a kind of gradual improvement on the consumption, particularly on the services side. We also see Chinese customer looking for a good value of products, and then the saving rates continue to be still quite high as well, which allowed potential longer term growth in terms of the consumption side. The other side I think is getting more interesting is that China it's moving away from producing lower value products to more higher value products. And this will probably means that it will help it to kind of broaden the export horizon. As you may see, they continue to be kind of building on capacity or capabilities related to green investments, EV vehicles, solar panels, batteries. And these are some of the areas that they've been striving to become stronger, both in terms of manufacturing and export as well.
Vanessa, we reported a while ago that PPI in Japan was up 2.4% year-on-year numbers. That was better than the survey estimate, or higher than the survey estimate. Could be good for corporates, I suppose, in Japan. Month on month, it was also stronger than the survey estimate, up 0.7%. And perhaps it's making it a little easier on the Bank of Japan, but I'm not sure if these numbers are even strong enough to be auguring for any kind of rate hike in the very near future. What are you expecting from the BOJ?
Yeah, I think you're spot on. If you look at the market expectations, they do expect there's going to be 2 hikes before the end of 2024. But looking closer in terms of the next meeting, we're probably unlikely to see a hike in the near future. Reason being, one of the key factors that the wage growth is still actually fairly gradual. And if you look at the wage growth percentage is still in the negative. So the wage and inflation dynamics is probably haven't been quite in line with the expectations that BOJ have laid out. If anything, it's probably an opportunity for BOJ to continue to communicate to the market and manage the market expectation and paving a way for gradual normalization when it comes to rates.
I think the other question here is on the persistent weakness in the yen and whether there's been a conversation between the Ministry of Finance and the BOJ about doing something to reduce the level of importation of inflation into the Japanese economy. Because at the consumer level, I think consumers are feeling that pinch. Is that wrong-headed?
I think if you think about on the macro front, it's probably unlikely that BOJ is going to have much actions. I think the weaknesses on yen could be a consideration, but if you kind of hinges back in terms of the role of BOJ, is really kind of looking at inflation other than thinking about the foreign currency. So that's probably where the kind of roles and responsibility definition would kind of win, I would say.
Vanessa, we're also pointing toward the CPI report in the United States coming up tomorrow. That's going to be a big one. Are you expecting those numbers to surprise much or to come in fairly close to in line?
I think the market expectation or the general expectation is probably coming fairly close in line with consensus. I think what is quite interesting as well is that dialing a little bit back for last week, we have a fairly interesting week where we see some weakening of the labor data, but subsequently followed by a very relatively upside surprises on the non-farm payroll. And I think inflation will continue to be a key thing to watch when you come to the Fed actions as well.
Vanessa, thank you for coming into our studios with us live here on the radio. Vanessa Chan, head of Asian fixed income investments at Fidelity International.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.